Welcome to the Capital Stack Show, Real Estate Syndications and Funds.
Welcome back to the Capital Stack Show, Real Estate Syndications and Funds with Shams Merchant. Shams is a commercial real estate private equity attorney who represents syndicators, sponsors, and real estate funds nationwide, helping structure deals, raise capital, and stay compliant with securities law. I'm Leanne Lyon, and today we are talking about how to raise capital legally without violating SEC rules. Hi, Shams. It's great to see you
Hi,
again.
Leanne. Yeah, thanks so much for having me again.
It's beautiful. So, at what point does raising money for a real estate deal become a securities offering?
Fantastic question. So, anytime that you raise money from investors that are going to be passive investors, right? Passive meaning they don't have any managerial rights. They don't have any rights to uh, to 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 conduct the project, to do anything related to the project itself, right? So they're just purely passive. All they have rights is economic rights, rights to receive distributions, rights to receive profits and losses. That's when you're dealing with the SEC. That's when you've essentially sold a securities to someone. Again, best example is I think what we mentioned in our last podcast episode, right? You buy a share of Apple stock, you don't have the right to tell Apple CEO how to run the company. You have bought a securities, and when you invest in a syndication or you invest in an investment fund, you're doing the same thing. The only difference is it's just a private share that you're buying of the company. It's not offered on a public exchange, but you've essentially done the same thing, right? That's a securities interest. So anytime that a syndicator or a fund manager is raising capital and they're raising capital from passive investors, they are selling securities. They are under the purview of the SEC. They're under the purview of the state securities regulators, and they have to abide by securities laws when they're doing that.
Okay, and today we're going to use a few terms, technical terms, things like that. So, uh, for the audience, just pay attention. But this is really fascinating too. What is Regulation D? D is in dog, and how does it shape the way real estate syndications raise capital?
So we're going to start from the top on this one. So anytime you sell securities, the SEC says that you have to publicly register them with the SEC, right? So that's the fundamental law. Now, when you don't do that, right? The exception to that is the SEC has created exemptions from public registration. That's how this whole industry of syndications and private funds works, right? The main rule is if you're going to sell securities, register them. The exception to that is here's a few ways you can sell securities on the private market without registering them. And that's what Regulation D actually is. Regulation D is a safe harbor under the SEC that says you can sell private securities to investors if you comply with these requirements. And Regulation D is then broken up into what we call Regulation 506B and 506C. Both have their unique rules and procedures, but those are the two main exemptions that my clients use and then most people use in this industry when raising private capital. There's also Regulation A, Regulation CF. We handle those as well. We structure those for clients too, but I would say 97% of clients fall under Regulation D and under 506B and 506C. That's also because those are the two exemptions that are the easiest to use as well and have the least amount of restrictions. For example, under either 506B or 506C, you can raise an unlimited amount of money from an unlimited amount of investors with some caveats, but you don't have limitations on the amount, right? Which is fantastic. Under 506B, however, there's a couple of things to keep in mind. The first is you cannot publicly solicit investments from investors What that means is 506B is what we colloquially um, refer to as the friends and family exemption, because it only allows you to raise capital from investors that you have a pre-existing relationship with. And the SEC hasn't fully defined what a pre-existing relationship is. It's more of like a case law based test. Uh, but you know it when you see it, right? It's having some kind of relationship with the person that you are raising capital from, right? So I can't just go out, onto the street and um, offer my investment to someone I don't know. That would be soliciting, right? But if I have a friend, let's say his name is John. I know John, right? He's a buddy of mine. I can go and offer my investment to him because I have a pre-existing relationship with John, right? Um, or my clients always ask me, well, what if I met someone for coffee, a couple weeks before? We didn't talk about that I have this opportunity. We talked about it. We talked about me in general and my business, and then now I have this opportunity and I want to be able to present it to them. That's generally fine, right? I think at that point you've established a pre-existing relationship because you didn't originally meet them just to offer them this investment, right? So again, it's not really a hard and fast rule, but you know it when you see it, and that's what 506B requires, right? It's you can't publicly solicit investments. You can't run Facebook ads. You can't run Instagram ads. You can't post on social media that you have this offering to the world, right? You can only offer it to people that you know that you have a pre-existing relationship with. However, there's a benefit though to 506B, and that is that you can actually raise capital from non-accredited investors. So typically under the SEC, you can only raise capital from what we call accredited investors. Accredited investors is a defined term by the SEC. And is defined as someone that individually makes $200,000 of income, or has $1 million net worth, or makes 300,000 joint. And the SEC says that if you're going to raise capital from private investors, um, uh, you have to raise from accredited investors. They have to meet that definition. So the goal of the SEC is to protect the public from bad investments. So that's why the SEC says that you have to raise from accredited investors, because what the SEC is saying is that those people generally are sophisticated enough to make investment decisions by themselves, and to take on the risk of those investments going wrong. So that's what you're typically required to do. However, under 506B, you have this additional exception, which lets you raise money from non-accredited investors, but up to only 35 of them. So under 506B, you can't publicly solicit, but you can raise uh, capital from non-accredited investors up to 35. You can have an unlimited amount of accredited investors. Okay, so that's 506B. Um, Now on the flip side, we have 506C. 506C lets you publicly solicit investments from any accredited investor, um, all over the country, right? So you are not limited to friends and family. You are not limited to pre-existing relationships. You can go out and you can run advertisements, you can run mailers, you can do email campaigns, you can do whatever it is to go solicit money from whoever you want as long as they're an accredited investor, right? So under 506C, you have to verify that they are accredited before they invest with you, because under that vehicle, you are limited to only raising money from accredited investors. But on the flip side, you're allowed to go solicit those investments to the world, right? Which really opens up your investor pool, um, and lets you potentially raise more capital from other people that you might not know in your own network. Um, and so those are kind of the two sides of the coin as far as Regulation D goes. Each of them has some additional rules as well, but those are the main rules that I at least want to cover on this show. And those are the two primary vehicles that clients use when raising private capital for their syndications for their funds.
So I have one quick little tiny follow-up question. So you mentioned John, your friend that you know, and then John's cousin Cindy. John's
Yeah.
like, "Oh, my cousin Cindy would love to be part of this." Is that pre-existing?
That's a great question. Again, it's kind of on a case by case basis. We have to evaluate it and see, what the situation looks like at the time. But generally, yes, that would be fine. If John introduces Cindy to you, you meet Cindy, and then, after you've met Cindy, you then offer her this this investment opportunity under 506B. That's typically okay, right? Um,
Oh, I
it might not be as okay if the first interaction with Cindy is you offering her investment into your syndication, right? You want to first build a relationship with Cindy, right? Which can be really one meeting, right? One interaction is generally sufficient for that, as long as that first interaction is not you soliciting investments for your opportunity.
Well, she could even be aware of it because John's told her,
Sure,
but
that's
as
okay.
long as you're not soliciting, right?
Exactly,
Okay, excellent.
exactly.
Shams, what are the biggest misconceptions people have about raising capital in real estate syndications?
Well, yeah, I mean, people, first and foremost, if they haven't raised capital before, sometimes they're just not aware of these rules. Like they're not aware that when they're raising money from investors, whether that's friends, family, or anybody, that they're still under the purview of the SEC and the state securities regulators. There's no exception from those rules. Like you can't just you can't go raise capital and not fall under the purview of these legal bodies and these regulators, right? That's the reality. So some people don't know that, right? They might go and create an LLC and go take investments from people who are going to be passive investors who have no rights to manage the project or to say when the project can be bought or sold or have any managerial decision making power at all, um, and they won't abide by these rules. That's going to cause potentially a lot of problems down the road, right? Especially if a regulator gets a whiff of, them doing this, right? There's criminal penalties involved, there's civil penalties involved, and it can go really bad. Um, so that's one thing is some people just are not aware that these rules apply to them for what they're doing. Um, the second thing that I want to make sure people are aware of is that um, there's there's another way to structure these investments that are not particularly that fall under like a syndication or a fund or raising private capital, and that's called a joint venture. And I'm gonna talk about that in much more deeper in other episodes. But really, a joint venture is a vehicle that is exempt from all of these laws and these regulations because a joint venture um, is when you have investments from people in a group, right? You have people coming together to do an investment, but all of those people have managerial rights and decision making power in that deal. That's a joint venture, and why that's not selling securities is because those people have an active role in the project. And are actively involved and have managerial rights and decision making power. That's why you're not selling securities. It's a much more deeper legal analysis than just that. There's a full test that we would do to make sure that you are in fact not selling securities. Um, but that's something just to keep in mind is that for certain situations you can do a joint venture if you and a couple of people are getting together to operate or buy a project, and everybody has a legitimate decision making right and a legitimate active role in that business, then you're not selling securities. And you're not under the purview of the SEC. You're not under the purview of all of these laws, and you don't have to do all the lengthy paperwork and all of that we do to structure these investment vehicles.
I look forward to that episode. So, as we wrap up today's episode, however, what are the real consequences if somebody gets it wrong? Whether it's violating an exemption or not complying with the rules, what could happen?
Yeah, the number one thing that typically happens is you potentially get flagged by a state securities regulator. For example, in Texas, we have the Texas Securities Board, but in each state, there's a different name for that entity, right? And then at the top federal level, you have the Securities and Exchange Commission, the SEC, that everyone is typically aware of. If you don't do things right and someone reports you right to the SEC or to a state securities board, or they find out, through some other channel, that you've raised private capital and you haven't done it the right way, you've violated securities laws or anything like that, you could be hit with significant civil penalties, right, for failing to do that, and potentially criminal penalties as well. Typically, clients get into this situation when deals go wrong versus when things go right. When things go right, typically, they'll do the project even if they didn't set up things the right way, even if they completely violated all securities laws. No one's really going to the SEC to tell on them because there's really no reason to. But it's when something goes wrong and you have an investor that potentially gets upset, and they say, okay, well, I'm going to go tell the SEC. That's when you get on their radar. And that's when an inquiry might be opened up into your business. And if the SEC looks into you and you haven't done things the right way, or a state securities regulator looks into you and sees you haven't done things the right way, then they can potentially sue you for those, for civil and or criminal penalties. So that's typically when you see something like that happening. Um, and because look, the SEC is a federal body with, again, limited resources. They can't go chase every single person, right? There's a lot of people doing real estate projects, business projects, raising capital, and the SEC doesn't have the resources, nor does the state securities regulator have the resources to go track down every single person. But when they get a lead, a legitimate bona fide lead, they have to typically look into it. And that's really when things go wrong, is when an investment has not gone according to plan and you didn't do things the right way and someone reports you to one of these agencies. You're going to get in a lot of trouble. And it's going to be very costly to then fix it at that end, and to deal with the penalties than to just do it the right way up front.
Excellent. And again, a great reason to have a consultation with somebody who knows what they're talking about. And that is it for today's episode of the Capital Stack Show. Real estate syndications and funds. Raising capital is one of the most important parts of any deal, but doing it the wrong way can create serious legal and financial problems. Understanding the rules and how to operate within them is critical to building a sustainable real estate business. For more information or to connect with Shams, visit www.cre.law. Thanks for listening, and remember to like, leave a review, and subscribe to the show so you catch every episode. Thank you, Shams.
Thanks so much.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.